Imagine waking up tomorrow morning, checking your phone, and seeing that the price of silver hasn't just doubled, but it has skyrocketed past $100 an ounce. The stock market is flashing red, panic is setting in on Wall Street, but the metal in your safe is suddenly worth a small fortune. Is this just a fantasy, or are we staring at the greatest wealth transfer in history? Today, we are going to look at the undeniable signs that a massive squeeze is coming, one that could send silver to $120 and crash the rest of the economy. Welcome back to The Hidden Guy. If you have been feeling like something is fundamentally broken in our economy, you are not alone. We are living through a time where up is down, debt is considered wealth, and the paper money in your wallet is losing value faster than you can earn it. Today, we are going to dive deep into a scenario that financial insiders are whispering about behind closed doors. We are talking about the perfect storm for silver, a convergence of supply shortages, industrial demand, and monetary collapse that could trigger a move so violent it will make the crypto bull runs look boring. But before we get into the charts and the data, I need you to do me a quick favor. If you want to stay ahead of the curve and protect your financial future, go ahead and hit that like button right now. It helps the channel grow and ensures this information gets out to more people who need to wake up. And if you haven't already, subscribe to The Hidden Guy and turn on notifications so you never miss an update. We are building a community of critical thinkers here, and I want you to be a part of it. Now, let's get into the meat of this. Why are we talking about silver hitting $120? To the average person, that sounds impossible. Silver has been manipulated and suppressed for decades. It is the most unloved asset on the planet. But that is exactly why the opportunity is so massive. You have to understand that markets move in cycles, and we are currently at the end of a long-term debt cycle. When these cycles end, they don't end quietly. They end with a bang. They end with a currency crisis. And when faith in paper currency dies, history tells us that money flows into hard assets. Gold is the king, but silver is the people's money, and it moves like a coiled spring when the pressure is released. We are going to look at the mathematical impossibility of the current silver price, the industrial vacuum that is sucking up every available ounce, and the historical precedents that prove a move to $120 isn't just possible, it is actually conservative if you adjust for inflation. To understand where we are going, we have to look at where we have been. History doesn't repeat itself, but it definitely rhymes. The silver market has a personality, and it is a volatile one. Let's go back to 1980. This was the era of the Hunt brothers. Nelson and William Hunt were two oil tycoons who realized that the US dollar was being devalued by inflation. They decided the best way to protect their wealth was to buy physical silver. And they didn't just buy a little bit, they bought almost all of it. They accumulated so much physical silver and futures contracts that they effectively cornered the market. The price went from around $6 an ounce in 1979 to nearly $50 an ounce in January 1980. In today, S-money, adjusting for inflation, that $50 is closer to $150. Think about that for a second. The price exploded because of fear, inflation, and a shortage of physical metal. But then, the regulators stepped in. They changed the rules of the game overnight to stop the Hunt brothers, causing the price to crash back down. This event, known as Silver Thursday, destroyed the Hunt brothers' fortune. But it proved one thing: silver can move faster and harder than almost any other asset on Earth. Fast forward to 2011. We saw another massive run-up. This time, it wasn't two brothers, it was a reaction to the 2008 financial crisis. The Federal Reserve printed trillions of dollars to bail out the banks, creating fears of hyperinflation. Investors rushed into silver, driving the price from $4 all the way up to $49.83. It was a 1,130% move. Just like in 1980, it touched that $50 mark and then was slammed back down. Why does this matter today? Because the conditions we are seeing right now are a combination of 1980 and 2011, but on steroids. In 1980, we had inflation. In 2011, we had money printing. Today, we have record-breaking inflation, unprecedented money printing, and a debt crisis that makes 2008 look like a walk in the park. The setup is identical, but the scale is much, much larger. The crash that followed these peaks is also important to study. In 2011, after hitting nearly $50, silver entered a brutal bear market, falling down to around $13. In March 2020, during the pandemic panic, it briefly dipped below $12. This volatility scares average investors away. They see the crash and think silver is a bad investment. But here on The Hidden Guy, we look at things differently. We know that volatility is the price you pay for performance. Those crashes were caused by paper market manipulation and liquidity crunches, where investors had to sell everything they owned to cover margin calls. But every time silver crashes, it eventually rebounds higher than before because the fundamental value of the dollar keeps dropping. The paper price can be smashed down, but the physical demand never goes away. And that brings us to the most critical part of this puzzle. the physical shortage. This is where the story changes from a monetary speculation to a supply and demand crisis. In 1980 and 2011, the demand for silver was largely investment-driven. People were buying coins and bars because they were scared. Today, investment demand is high, but industrial demand is absolutely exploding. You see, silver is not just a precious metal, it is an industrial metal. It is the most conductive element on the periodic table. You cannot have a modern economy without silver. It is in your iPhone, your laptop, your car, your light switches, and most importantly, it is the key ingredient in the green energy revolution. Let's talk about solar panels. The world is aggressively moving toward renewable energy. Governments are mandating it. Solar panels require silver paste to conduct electricity. As solar technology becomes more efficient, it actually uses more silver, not less. We are talking about gigawatts of solar capacity being installed every year. The solar industry alone is consuming over 100 million ounces of silver annually, and that number is projected to double. Then you have electric vehicles. An EV uses almost twice as much silver as a gas-powered car. It's in the battery management systems, the connections, the computerized components. As the world transitions to EVs, the demand for silver in the automotive sector is going parabolic. Now, here's the problem. While demand is skyrocketing, supply is falling. You can't just snap your fingers and produce more silver. Most silver is mined as a byproduct of lead, zinc, and copper mining. That means miners aren't looking for silver specifically. They just find it while digging for other stuff. Because of this, silver supply is inelastic. Even if the price goes to $100, miners cannot instantly ramp up production. It takes 10 years to bring a new mine from discovery to production. We have seen years of underinvestment in the mining sector because prices have been suppressed for so long. Mines are getting deeper, ore grades are getting lower, and the cost of energy to run these mines is going up. We are currently in a structural deficit. The world is consuming more silver than it produces. For the last few years, we have eaten into the above-ground stockpiles. But those stockpiles are not infinite. The warehouses in London and New York are bleeding silver. We are seeing inventories drop to dangerous levels. When the industrial users, the companies like Apple, Samsung, Tesla, realize there isn't enough physical silver to build their products, they aren't going to look at the paper price on the COMEX. They are going to pay whatever it takes to get the metal. They will bypass the futures market and go straight to the refineries. This is when the paper price disconnects from the physical price, and that is when you get the vertical move to $120. It won't be speculators driving the price. It will be panic buying by major corporations who need the metal to survive. While the industrial squeeze provides the floor for the price, the monetary collapse provides the rocket fuel. We have to talk about the US dollar and the Federal Reserve. The United States is $34 trillion in debt. The interest payments on that debt are now higher than the entire defense budget. This is a mathematical death spiral. There is no way to pay this debt back in real terms. The only option the government has is to inflate the debt away. They have to print money to pay the bills. This debases the currency. When you print trillions of dollars out of thin air, the purchasing power of every existing dollar goes down. This is why your groceries cost more. This is why housing is unaffordable. It's not that things are becoming more expensive, it's that your money is becoming worth less. Silver is the ultimate hedge against this debasement. For thousands of years, an ounce of silver roughly equaled a day's labor for a skilled worker or a soldier. Today, at roughly $25 or $30, it is laughably cheap. It is arguably the most undervalued asset in the world. If we look at the gold to silver ratio, it gives us a clear signal. Historically, the ratio of gold price to silver price sits around 15 to 1. That means it takes 15 ounces of silver to buy 1 ounce of gold. This comes from the fact that silver is roughly 15 to 17 times more abundant than gold in the Earth's crust. Currently, that ratio is fluctuating around 80 to 1. This is a massive anomaly. Let's do some quick math. If gold goes to $10,000 an ounce, which many experts believe is conservative given the amount of money printing, and the gold to silver ratio returns to its historical average of 15 to 1, that puts silver at over $600 an ounce. But let's be conservative. Let's say the ratio just goes back to 30 to 1 and gold hits $4,000. That still gives us silver at over $130. The target of $120 isn't a moonshot prediction. It is simply a reversion to the mean. It is silver catching up to where it should be relative to gold and the money supply. But here's the scary part. A move like this usually coincides with a loss of confidence in the system. If silver is hitting $120, it means something is breaking in the broader economy. This brings us to the potential market crash. Historically, precious metals often spike right as a recession hits or during a stagflationary crisis. We are seeing signs of a recession everywhere: inverted yield curves, slowing manufacturing, and a struggling consumer. If the stock market crashes initially, silver might take a hit. In a liquidity crisis, everything gets sold. We saw this in March 2020. silver crashed along with stocks. But then, the Federal Reserve stepped in with stimulus, and silver tripled in price in 5 months. The next crash will likely trigger an even bigger stimulus response, launching silver into the stratosphere. So, how does this $120 scenario actually play out? Let's paint the picture. It likely starts with a trigger event. Maybe it's a failure in the bond market, maybe a geopolitical escalation, or maybe a major mining shutdown. The price of silver starts to creep up, breaking past $30, then $50. This catches the attention of the mainstream media. Suddenly, CNBC and Bloomberg are talking about the new gold. Retail investors, the Reddit crowd, and the momentum traders pile in. This creates a feedback loop. As the price rises, the short sellers, the big banks who have bet against silver, start losing billions. They are forced to cover their shorts, buying back silver at higher prices, which drives the price even higher. This is a classic short squeeze. At the same time, the industrial users panic. A company like Tesla or Samsung sees the price rising and realizes they might not be able to get the silver they need next month. They start stockpiling. They buy 3 years' worth of inventory instead of 3 months. This drains the physical market completely. You go to your local coin shop, and the shelves are empty. You go online to buy bullion, and the premiums are 50% over spot price, or it's simply out of stock. The paper price on the screen might say $80, but to actually get a physical bar in your hand, you have to pay $120. This is when the decoupling happens. The paper market, which is full of unbacked contracts, becomes irrelevant. The real price is discovered in the physical market. As silver crosses $100, we will likely see mania. People will be trading their dying dollars for anything tangible. But remember, this happens alongside economic turmoil. The cost of living will be skyrocketing. The stock market might be down 40 or 50% in real terms. Your retirement account might look okay in nominal dollars, but it won't buy anything. This is why holding physical silver is insurance. It's wealth outside of the system. It's an asset that has no counterparty risk. If the bank fails, your silver is still there. If the power grid goes down, your silver is still valuable. However, we must also be realistic about the crash. If we see a deflationary crash first, where credit dries up and the economy freezes, silver could drop sharply before it rallies. This is the shakeout before the breakout. The weak hands will be scared out of their positions. The smart money, the viewers of The Hidden Guy, will use that dip to back up the truck and buy more. You have to have a stomach of steel to ride this bull. It will try to buck you off. It will be volatile. You will see 10% swings in a single day. But if you understand the fundamentals, the supply shortage, the debt, the industrial demand, you will hold on. To wrap this up, the case for silver hitting $120 is not just wishful thinking. It is based on cold, hard data. We are looking at a perfect storm. We have a historic supply deficit that is getting worse every year. We have explosive industrial demand from the green energy transition that is non-negotiable. We have a monetary system that is mathematically guaranteed to fail, requiring infinite money printing that destroys the value of the dollar. And we have a market that is so small and so shorted that when the rush for the exit happens, the door won't be big enough for everyone to get through. The move to $120 will likely be chaotic. It will happen amidst a backdrop of economic fear and uncertainty. But for those who are prepared, for those who hold the physical metal, it represents a life raft. It represents a way to preserve your purchasing power and transfer your wealth to the other side of this crisis. The window to acquire silver at these suppressed prices is closing. Once the breakout happens, it will be too late for the majority of people. They will be chasing the price, buying at the top, while you will be sitting comfortably watching your foresight pay off. I want to hear from you in the comments below. Do you think silver will hit $120 in the next 2 years? Or do you think the manipulation will keep the price down forever? Let me know your price targets and your strategy. This community is one of the smartest on YouTube, and I learn from your comments every day. Also, if you found value in this deep dive, please share this video with a friend or family member who needs to wake up to the reality of our economy. The more people who are prepared, the better off we will all be. Don't forget to like and subscribe to The Hidden Guy for more unfiltered truth about the markets. Until next time, keep your eyes open and your assets hard. Thanks for watching.